In this video, we are going to talk about another high dividend ETF listed in ASX. It is provided by Vanguard and it is called Australian High Dividend Yield ETF with the ticker code VHY. We're going to compare VHY and SYI from Spider or State Street about their similarity and differences. Because thanks to Mr. Quintuple X, I found something that is common for BlackRock IHD and Spider SYI. That is, dividends received are quite sensitive to commodity price. This is mainly because BlackRock IHD and SYI invest in BHP, Fortescue Metal Group, and also Rio Tinto. But what's different with Vanguard VHY, if you look at on their top holding details, they also invest in the big four banks of Australia: CBA, NAB, Westpac, and ANZ. On the last part of the video, we're going to talk about the financial performance for the big four banks versus the financial performance with the three mining giants, so that we gain some understanding with this whole Australian dividend ETF. Let me remind you that this video is not a financial advice. I'm not trying to prove to you that Vanguard is better than Spider SYI or vice versa. I'm just simply giving you something informational and hopefully useful to you. So let's start with the Vanguard VHY. VHY has a management fee about 0.25% per year, and the fund was started around May 2011. They do quarterly distributions 4 times a year, and the total fund size is pretty huge. It's about 3.5 billion as of September 2022. And if we look at the performance return, according to Vanguard website, they've done about 8.6% per year for the past 10 years. And I want you to pay attention with this ETF overview because I think it explains why VHY is different from BlackRock IHD and also Spider SYI. That is, they are focusing on the security diversification, and it is achieved by restricting the proportion of each sector by 40%. For example, they're not gonna go all out on all mining names. They're gonna max it out at 40%. And they also put restriction by about 10% of any company. So they're not gonna put 15% on BHP, for example. Whereas Spider SYI, which you can access on CommSec Pocket, I'm not endorsing CommSec Pocket for you, this is just informational, has a management fee about 0.35% per year. And Spider SYI follow an index by Morgan Stanley, whereas Vanguard follow the index from Financial Times. And according to Spider SYI website, they've done 5-year annualized return about 6.3%, and since inception return annualized about 7% per year. Let's have a look at the holding details for Vanguard VHY. It has 71 holdings within the ETF, and the top 30 holdings constitute about 92% of the portfolio. And like I said before, it is different from BlackRock IHD and Spider SYI because Vanguard VHY invests in the big four banks, with a total about 28% weight based September 2022. And they invest in the three mining giants, BHP, Rio Tinto, and FMG, by about 16% weight. This is what we're going to compare for the rest of the video. How big is the dividends from the big four banks compared to the dividends payout from the mining giants? We're going to use the financial results from financial year 2021 because that's what's available now. Because from the previous video, when we take the snapshot of the financial performance of 2021, we found out that iron ore price, the commodity price, play a significant role with the dividend being paid out to these two ETF. Again, this is not financial advice because the exact amount of dividends that your ETF will receive will depend on how many shares that ETF holds. But it's pretty significant because, say in financial year 2021, for example, Spider SYI, the 31 companies within Spider SYI pay out a dividends about $49 billion. And at least 70% of that comes from the three mining giants, BHP, FMG, and Rio Tinto. So how about with Vanguard VHY? And this is what I found. So in Vanguard VHY, it has 71 holdings. From that 71 companies, they generate a total net profit after tax about $113 billion in 2021. And out of that, they paid $73 billion in dividends. And the big four banks, CBA, NAB, Westpac, and ANZ, contribute about $15 billion out of that $73 billion, which is about 22% of the total dividends. And the three mining giants paid out about $39 billion, which is about 54% contribution to the total dividends. And just to give you a general idea how much contribution BHP, FMG, and Rio Tinto has given back to the shareholders. But what is interesting is that if you add up all the total asset of the big four banks, it's at least $3.9 trillion, whereas the three mining giants is only about $324 billion. And yet the three mining giants paid more dividends than the big four banks. And that comes to what sort of risk that you are comfortable with. With the mining giants, obviously, they have to focus on reducing costs and make sure the mining operation is being done efficiently and within the acceptable safety standard. But it is sensitive to the commodity price. Whereas the big four banks, if we look at the history of the dividends being paid out, for example, for Combank, it has been steady and increasing from 2012 till 2019. And then the COVID pandemic happens, they still pay dividends. And by the way, 48% of CBA revenue are from the retail banking. That is your day-to-day transaction, your home loan, for example. And the same pattern happens with NAB as well, that has a reduced dividend being paid out in 2020. But it's very different with the mining giants. For example, BHP, which has gone through some safety drama in 2016. Because of that incident, they have paid very little dividends. In 2020, in the COVID pandemic, they still paid dividends a similar amount back in 2015. And for the past couple of years, 2021 and 2022, they've been paying a lot of dividends to the shareholders. And by the way, 56% of BHP revenue is from iron ore. The same with Rio Tinto. If you just look at the trend line for the past 10 years, the dividend has been steady and increasing. And the COVID pandemic that happened in 2020 that slows down the banks didn't affect Rio Tinto as much. And that's why I say in many of my videos is that business earnings are dynamic and business go through good times and also bad times. And this is the last part of the video. If you check out the rest of the 30 holdings, Vanguard VHY with its Financial Times index, they're also investing in oil companies such as Santos and also coal mining companies such as Whitehaven. So make sure you're comfortable with that. Thanks for watching.